Hey guys, welcome to Finance and Governance. On this lesson, we'll be focusing on audit risk and materiality. What is materiality? Materiality is the threshold where a financial misstatement will influence users' decision. For instance, 1 million rand error in a small business is material. The same 1 million rand typo in Apple's $400 billion revenue, probably not. But if that error hides fraud, even if it's small, it's suddenly material because context matter. Next up, what is audit risk? Audit risk is a chance that an auditor accidentally gives a clean opinion on financial statements that are actually misleading or contain significant errors. It's like a doctor missing a hidden illness during a checkup. Despite doing tests, something critical slips through. So, there are three types of audit risk: inherent risk, control risk, and detection risk. Inherent risk is risk of error due to the nature of the business, which is driven by complex transactions or industry risk. Control risk that a company's internal control fail to detect errors. So both inherent risk and control risk are risk of material misstatement. Detection risk that the auditor's procedures fail to catch material misstatement. Risk of material misstatement plus detection risk will be the audit risk. The formula is audit risk equals to inherent risk times control risk times detection risk. Components of audit risk: the likelihood that a specific account or group of transactions contain inaccuracies. This means that some accounts are more likely to have material misstatement because of the nature of the business. Control risk: the possibility that errors in a specific account or transaction groups might be important enough to matter either by themselves or when with other misstatement. Control risk: the possibility that errors in specific account or transaction groups might be important enough to matter either by themselves or when with other misstatements. If in a company there are no segregation of duties in a way that an employee can approve expenses and record payments, that's a high control risk for fraud. You can't approve expenses and record them. You are determined to commit fraud. Seriously, think about it. Detection risk: the possibility that an auditor design procedures won't identify material misstatement either by themselves or when with other misstatement. Even after an auditors do their work to minimize risk, there's a possibility that they might overlook a single important error or miss several smaller errors that together become important. I want you to think of it like a security system. Inherent risk being how valuable the target is. Control risk is the quality of the company's safeguard, how strong the logs or alarms are. Detection risk is how thoroughly the guard checks for breaches, the guard being the auditor in our case. So, the relationship between audit risk and materiality is an inverse relationship. The more material certain components of a company's financial statement are, the lesser the amount of audit risk. So what part of the audit risk do you find the trickiest? Comment below. And please guys, don't forget to subscribe, like, and comment. Please invite your friends too. How? Don't be selfish. Don't gatekeep.